just an introduction on who you're talking to here. My name is Nick. I'm going to be the MC. I'm going to try to explain everything like 5 years old. Mitchell's going to correct me, elaborate, and get a little bit more technical into the tax code. I'm a real estate entrepreneur. Mitchell Baldridge is a great friend of mine and the smartest tax mind I know. He's a CFA and CPA based in Houston, Texas, owns his own practice. Let's tell people what we're going to discuss today. I think we're going to talk about bonus depreciation. We're going to talk about what July of last year and the big beautiful bill did for that, how it works. We're going to talk about real estate pro status. We're going to talk about recapture. We're going to talk about 1031. I think it's fair to say real estate is one of the most powerful tools and levers you can use when it comes to tax reduction. How's it sound, Mitch?
Sounds great.
Now, depreciation is the most important part of this, Mitchell, and it's how a lot of real estate investors and entrepreneurs in general are able to make a lot of money and not pay much at all, if anything, in taxes. And the big beautiful bill supercharged this. Why don't you give us the breakdown? I'll try to fill in the
Sure.
gaps where possible, and then we'll tie it all together with how it works in a practical sense.
So yeah, if we're at the How to Pay Less Tax webinar, I have a tweet of all business roads eventually lead to real estate. And real estate's the best tax efficient business there ever was because you can get leverage on it. You can buy it freely with good debt, and you get all of this depreciation upfront that's out there today. So you get this kind of tax-free cash flow. So depreciation in nominal terms is, let's say you buy a stapler or you buy even a $900 MacBook Air. So there's this, that is an expense in your business. That's a supply in your business. You're freely able to write that off against your business income the year that you buy it. Nobody looks twice at it. But once you start buying $1 million buildings, even really big machinery and equipment, that's when you start to get into a different section of the tax code where this is a type of property that's a long life asset that's viewed on a longer time scale by the IRS. So typically, if you go buy a rent house, it's on a 27 and a half year window. So you get to deduct 3.5% of the property a year versus if you go buy an office building or one of these medical offices, you get 39-year deduction life. So you get to deduct 2.5%.
And this
It's worth
27 and
noting.
a half years and 39 years, these are outlined by the IRS as kind of the useful life of the asset. So it doesn't count
That's right.
land value. That's important. You pull land value out, that's non-depreciable at all. But if you buy a residential building, does this include multifamily as well, or is this only single family?
It's any type of living structure that any structure that someone's going to live in. So it's a single family house, it's a fourplex, it's a apartment skyscraper. So every single type of residential building has a shorter lifespan than they just assume commercial buildings are going to last a little longer. But
Yep. So
this has always
20.5
been
years is 3.63% of that price the value that you paid for it, straight line deduction every single year for 27 and a half years. You can deduct what would be in this example, you see $1 million building. Say it's a commercial building. If we spend $1 million on it, every 39 years, you deduct 29 or $25,600 against your taxes. So that in itself is quite powerful because if you buy $1 million building at a six cap, that's $60,000 a year of net operating income. 25,000 of that can be shielded, or 42% of it can be shielded from the IRS in the form of this deduction, this write-off, this phantom expense that you bought once and you get to deduct every single year.
and so assuming you had a $600,000 loan at
Hmm.
6%, you're going to have another 36K of interest. So that 36 plus 25 wipes out all the cash flow. Or sorry, not all the cash flow, wipes out all the taxable income from the building. The
Yep.
36 wipes out a little bit of the cash flow.
Yep.
So
Even though that 25K is not necessarily a actual line item going out the door expense.
yeah, so this is why real estate is the best business in the world. You can keep stacking up these properties and just put some moderate leverage on them, and so long as they pencil and you can pay the note, it's tax free all the way up until you're so rich that you have to pay taxes.
All right, so in this example of straight line depreciation, which is quite powerful, we're looking at 3.6 or 2.5% of the value of your property that you buy. 42% or so of your net operating income can be shielded from taxes, but it gets better. So now let's talk about items with quicker depreciation. And if you're in a building, okay, the frame of the building, the structure itself may have a 27 and a half or 39 year depreciable life, but there are items inside the building, different parts of the building that have quicker depreciation schedules. This is landscaping, sidewalks, parking lots. Stormwater structure is amazing for accelerated depreciation, earthwork, carpeting, accessory electrical, appliances, movable walls. That's huge in my industry of self-storage, and overhead doors. These things, what you can do is you can go in and do a cost segregation study, put a value on these different parts, and you can depreciate these quicker. Mitchell, what's the lifespan, for example? What's the useful life of landscaping, sidewalks, and stormwater infrastructure?
Yeah, that's all the kind of exterior side improvements are 15-year property. Some of these overhead roll-up doors, I believe they're 5-year property. So the idea that like everything fixed to the building that you would just sell along with the building. We're talking about when we talk about movable walls or overhead doors, those are interior overhead doors. The exterior overhead doors that are literally built into the frame of the building are still long life property. So they're saying, look, it's this 39-year asset, but think about all of the component pieces of the building that are going to have a shorter life. And that doesn't include the roof. You go, my roof's not going to last 39 years, or even the HVAC. You're not going to pull out the HVAC when you sell the building. That's going to stay there. But all of the tenant improvements, all of these kind of pieces or like R&D facilities, all of that would be short life. All of this equipment, all of this stuff that comes along with the building that's not a part of the structure gets to be, and this is the whole, we'll get to cost seg, but this is the whole idea, is you blow this building into its exploded diagram of every one of its component parts like it's on a blueprint, and you say, here's all the landscaping, here's all the earthwork, here's all the carpet and the luxury vinyl plank and accessory cabinets, like those beautiful cabinets behind you, like they're all not really a part of this office building. We're going to call all this TI and separate it and then get to bonus depreciation. And
Yeah,
so,
so I'll do my best to explain this in as simple a manner as possible. But a certain percentage of the cost, anything that's 15 years or shorter, which is all the things that I just listed, your landscaping, your appliances, some of your windows, your overhead doors, a lot of the different parts of the building are eligible for what's called bonus depreciation. So not only can you assign a value and depreciate them quicker under normal schedules, but as of now, and as part of the big beautiful bill that was passed in July of 2025, 100% of this value, anything under 15 years, is depreciable in year one. And if you're not paying attention, pay attention. Stop scrolling TikTok. Stop looking at your second monitor, checking emails, and focus on what I'm saying right here, because this is a big gold nugget of what we're trying to get across from you here. 100% of the value of 10, 15, even 30% of the asset that you bought, how much of it is 15, 10, 7, 5-year life, is depreciable in year one. So what does this mean? Let's give an example in self-storage. You buy a $1 million building with $200,000 land value, $1 million property, all in purchase price. 800,000 of it is building value, of which 30% of that might be the overhead doors, the stormwater, the sidewalks, the concrete, some of these things that are eligible for bonus depreciation. That's $240,000 of the value. This is your bonus eligible amount, of which, as of July of 2025, 100% of that can be taken as a year one deduction. Massive,
yeah,
massive. So $240,000 on $1 million asset can be taken as a year one deduction. This is why you hear so many people talk about buying real estate to get the bonus depreciation, the tax deductions. Now, there's risks to this, guys. We're going to talk about recapture. What goes up must come down when it comes to tax. You're going to eventually pay these taxes some way or another. So you have to be very careful about this. But if you put $500,000 down to buy $1 million building, like Mitchell said, you're going to borrow $500,000 from the bank. 48% of your cash down comes back as a year one tax deduction. That can be massive. So in an environment like 2021, when interest rates were lower and folks were buying buildings at 75, 80% leverage, not as common now, folks were literally getting more year one deduction than cash into a deal. And it was a very advantageous tax environment when it came to real estate.
This is why the real estate guys were just going berserk during zero interest. This is because you could literally take a very little capital down, go buy something, have a fairly low payment, and deduct more than what you put down year one, or as much as you put down year one. It makes it in effect like a 401k, but you don't have to wait till you're 59 and a half. You can borrow against it. There's all these benefits of it.
Yep. And Mitchell, you talk about kind of the five levers of bonus depreciation, which I think are really powerful way to think about it. And all six of these different things can change your tax rate and change the
Yeah.
advantageous nature of this. Land value is very important because land cannot be depreciated. So if you're going to go buy an asset in a vacant land, covered land play outside of Manhattan where real estate prices are very high, there's going to be very little depreciation. That lever will not be pulled. Now, if you're buying a property that's a very large building in a very rural area where land value is historically very low, that lever would be maximized and much room for improvement in the amount of cost seg advantages and depreciation that you can get. Lever two, Mitchell, you can go ahead and start ripping off a couple of these others.
Yeah, so back lever two is the percentage of what is that kind of long life property, that 39 or 27 and a half year property versus how much 5, 7, 15-year property is that? Does it have a ton of site improvements? Is it an R&D facility where most of the value is in this very specific build out to this one ideal tenant? Or is it just a tilt wall construction building that has nothing in it? We've
Yep.
gotten into some of those projects and we're just like, hey guy,
Block walls.
we
Yep.
didn't there's not much we can
No
do for
storm
you.
water, not very big parking lots,
Yeah.
lock walls, steel roofs, and very
Yep.
little material on site for actual accelerated depreciation. So that's
Yeah.
another huge lever of it.
Yeah, you can get a storage facility that's literally made out of cinder blocks rather than having the movable modular walls, and it's just a whole different building. Lever three we just talked about is the percentage of leverage. If you buy it with 100% cash versus if you buy it with zero cash because you're assuming the loan, you're going to have very different situations happen as to how much of a deduction you're going to get relative to the equity you're putting into the
And keep
deal.
in mind that maximizing some of these levers and increasing your tax advantage can also increase your risk as an investor and the chance that you could have losses. All of these bite both ways. So keep that in
So
mind.
yeah, this is leverage. Like you're especially in that ZERP phenomenon when people were doing highly levered deals. They were doing highly levered deals and then stacking on another chunk of leverage. Like this is what accountants would call a deferred tax liability.
Yep.
You are borrowing money from the IRS that they don't quite know you're borrowing, or they understand it, but they're willing to let you do it. You don't pay interest on it, but we'll talk more about recapture. But when you sell this thing, you got to pay it back.
You're
So,
kicking the can down the road. And I think another huge lever here is how long you're going to hold a building. If you're going to hold a
yes.
building 3 or 4 years, so deferring the taxes and paying those taxes 3 or 4 years down the road is valuable to you, which capital for most investors, real estate folks, entrepreneurs in general, capital is very valuable. So if you can get an interest-free loan from the IRS, you should do it. But you should know that you're going to need to pay that back. So some folks
And
themselves in situations where they depreciate. This happens in airplanes all the time. They buy a jet, they depreciate 4 or 5, $10 million, they depreciate it down to nothing. Then they have to sell it because they're in a financial bind. They sell it for 3 or 4 million. That entire sale proceed can be recapture and taxable. So even though you lose money on your deal and you still have to pay back your bank many times, when you sell your piece of real estate, you can actually have a tax liability with no cash to pay it. So you got to be very careful about these things. And
with your
lever four is the tax rate that you have. If you're in a very high tax bracket, this can be more valuable to you. If you're not in a high tax bracket, it's not very advisable to push that can down the road and take this as a loan from the IRS.
we
The
spend
percent,
a lot of time with like real estate pros saying, "Hey, let's not get you to zero. Let's get you to like 250,000 of income because you're going to be at the like 16% effective rate. Let's get you 16% times 250. Let's gladly pay it. And then let's carry your losses year over year because you're just going to lose $250,000 of losses that
hmm
could be used a 24% income bracket or a 32 or the highest income bracket rather than on those lowest brackets as you get to zero or less than zero,
Yeah, working with
as it
somebody
were.
like Mitchell to plan ahead is very important in all of this. And then the bonus depreciation percentage, which is now permanent at 100 because yours truly got elected president, is lever five.
Yours truly.
No,
I don't think that's
Orange
yours
Man.
truly, but
So
the
lever six is the payback ratio and how much cost you're gonna defer,
so
what percentage you're gonna spend on your actual study because you need to go pay an engineering team to do this work and get your building blown up and put values on all of it and give you a schedule to hand to your CPA.
it's a great time to talk about RE cost seg. We
Yeah, I'm a co-founder and investor in RE Cost Seg, which does this. This is what we do. We're not going to spend a lot of time giving you the big
sure.
sales pitch, but we have 45 engineers that devote every waking hour to finding more depreciation inside of assets and blowing them up in AutoCAD and maximizing tax savings for investors.
And so, yeah, what you pay for the study versus what the study is going to save you is ultimately a big piece of what drives the value. And if we'll give you a way to contact us towards the end, but when you contact us, we're going to just walk you through that, give you a free proposal and tell you, hey, this is your property. This is what we see. Here's the conservative. Here's the optimistic view. Here's
Mitchell,
what
while
it's
I'm
going
running
to
through this
cost you.
case study, you should drop in the calculator so that people can play around with it because I think
The
uh,
calculator is awesome.
the
Yeah.
calculator on RE Cost Seg's website. So this is a
Pointers.
really important part of all this, Mitchell, and it's not necessarily good news or sexy. And it's that the government actually treats different taxable income from different sources differently. You want to talk briefly about let's just simplify it into two types of income for folks and
Yeah.
what that means.
So simply your ordinary income, either from your W-2 job or from the business that you own and operate that you go to work at every day, is called active income. Then there's portfolio income, which is interest and dividends and kind of bank product income, capital gains. That's one chunk of income. And then there is something called passive income. And so in the 1980s, a bunch of hedge fund guys played a bunch of screwy games with the tax code. And then they revamped the entire tax code to build these different types of income so that you couldn't go invest in real estate and just wipe out your millions of dollars of leverage buyout income. They figured out how debt worked, and then they figured out how the tax code worked and said, holy smokes, let's go.
And then the government ended up saying that, hey, you have income that comes from your primary focus, basically. This is
Mhm.
ordinary income. This is either your W-2, your main business. For some people, this is real estate, for people with the real estate pro status. And then there's passive income. These are capital gains, capital losses of investments that you've made. These are potentially real estate investments. This is
I
investing as
gave
a limited partner, an LP in a real estate deal. If it's not your primary business, then it's two different buckets of income and it's two different buckets of losses. And those two buckets can't offset each other. Mitchell,
the IRS. Yeah. So if you lose money in stocks, you get to take $3,000 a year. You can't lose money in interest. But if you go invest in a bar and you don't work at the bar and you lose all your money, you don't get to deduct it off of your ordinary income until you call the entire business a loss. But so real estate income, real estate rental revenue is by definition passive. So if you earn rent dollars to lease out real estate, the IRS in the tax code just says this is passive income or passive loss, as it were. And it may not offset your active income from your job or from your ordinary business unless you are a real estate pro. And to become a real estate pro, they are very specific. You have to work 750 hours in more than half your time in real estate rental management, property management, construction, acquisition. They give you the categories, but you have to work your full-time job in that business. And
A
so,
business that you own at least 5% of, by the way.
yep. And
So basically, let's say we have somebody who's a stockbroker full time and they only spend 300 hours a year and 10% of their time on real estate. They make big investments. They did not qualify. They cannot use real estate investment losses through cost segregation and bonus depreciation to offset their primary income, their W-2 income.
there was a tax court case last year where somebody basically was, hey, I'm a broker, but I don't really work hard at my W-2 job. And I really spend all of my time working on this real estate portfolio. So I spend 1,000 hours over there and I spent 1,001 over here. And the IRS kind of said, we just don't buy it. You were paid for 2,000 hours over there. You did not spend 2,001 over here. You just couldn't have. That's impossible. And so basically, if you're a W 2 employee, you cannot be a real estate pro unless you're a W 2 employee for that owns 5% of a real estate business that employs you. You know?
So there's two loopholes. One is to marry somebody who is a real estate pro, because when folks are married, if you marry a real estate pro and you're filing jointly, if one person qualifies as a real estate pro, both people do, and you can use real estate investment losses, depreciation, bonus depreciation to offset the W-2 income. So sometimes you have a spouse who is a doctor or a stock trader or any number of high earning jobs, whereas the spouse is a real estate pro. They make investments as limited partners, even passive investments into real estate deals, and they indeed can use passive losses to offset active income because of the marriage rule.
Yep. But the second rule, you say, I can't make my wife do it. I can't make my husband do it. I'm not going to do it. So the second rule is STR loophole. So this comes principally, and I don't know if we're about to hit it next, but like you could, if you were a physicians group and you see this all the time, now go back, you can buy your own building for your own medical practice. So the radiologists go buy the office building and they run the tech suite out of the bottom of it, and they have the labs, and then they have the clinic upstairs, and maybe they lease to a podiatrist in the back. But like, they principally own and operate their own practice out of their own building. Like in Kansas or Indiana or like in the Midwest, every CPA owns their own building because the buildings are cheap and the rents are expensive, and they figure
And there's
out the
folks that
game.
work on cars that own their own building.
Yep.
There's folks who own trades companies like
So
HVAC, and they buy their industrial building. And you're saying, Mitchell, if you buy the building that you operate out of, these real estate pro and material participation rules do not apply, and you can deduct these losses against your active income.
because the building is incidental to the business. You say, hey, rather than renting a forklift, I'm going to buy my own forklift. And rather than renting office space, I'm going to buy my own office space. And so we're going to principally operate out of this asset we own and we use in the normal, ordinary business trade to run our business. And so the STR loophole is the same principle, only it's a house and you're running a hotel out of the house. So you basically buy a house, or you buy a sixplex, or you buy a little trailer
You're
like
going to run an Airbnb short-term rental business out of this thing.
Yep.
It's a higher touch business. You have to be the one who's doing the work. There's some rules around that. Talk to your CPA. We're running out of time. We got to get through this pretty quickly, but
Let's
if you're
go.
going to use it for less than 15 personal days, boom, all of a sudden active income and active losses, and these can cancel each other's out. So this is why a lot of high earners will buy a beach house. They'll go there for less than 15 days. They'll put it on a rental program. They will manage it themselves, and boom, they can use these losses to offset their active income.
Let's go.
Recapture. This is something that is very much worth touching on here. If you buy this $1 million building, we talked about $250K of depreciation taking over 3 years. Let's say later you sell it for $1.5 million. You're looking at $500K of capital gains, the 1.5 minus the original basis of 1, and $250K of recapture, because the $250K is the depreciation that you've taken, and this is taxed at the recapture rate. So keep in mind that if you buy a building for $1 million, you borrow $1 million to buy it, you depreciate $250,000 of it, then you have to go sell it for $790,000. You're going to have a taxable gain. There's a little bit of taxable gain there, even though you're going to owe the bank more money than you sold it for. There's people who can find themselves in massive trouble by taking too many losses. Obviously, you can 1031. Obviously, you can do some other things, but keep in mind that recapture is the rate that you pay later when you sell a building on all the money that you depreciated on that individual building.
And so the recapture rate on the long life property is 25%, but the recapture rate on all the short life property that you cost segregated is the normal rate. And so ordinarily you're going to have a big gain that year that you sell the building. So you're going to get jammed up on at the very top bracket on all the recapture. So if you didn't use the losses wisely, you're making a bad play here. So
Yep.
you just have to think it through.
Now, here's a plug. We're not going to spend a lot of time selling you guys, but we have a called a rapid report where we do $950 for a study on a lot of assets under $300,000, $400,000 total basis. I saw some really good questions come in regarding real estate, but if anybody has Q&A, let us know. Tatiana has a really good question. I'm considering purchasing a single family rental that may need cosmetic updates, which she plans to do herself. Her main question is whether the time spent on renovation and work before the property is placed in service can count towards the 750 hours of real estate professional hours, Mitchell. What's your opinion on that? She's basically spending time in her building doing remodeling, improving her piece of real estate. I would think that would count.
Yeah, yeah, absolutely. Renovating, construction, reconstruction, all time that qualifies for real estate professional status. That's another, like, somebody who just, my buddy Austin builds spec custom homes. And I always tell him, Austin, you're a real estate pro. You don't know this about yourself, but like you are sitting on a golden opportunity of you don't have to be a real estate private equity buyer, syndicator, property owner to necessarily be a real estate pro. You could be a broker, you could be a property manager, you could be a construction person. And whether you're constructing your own asset or other people's property, it counts. And you just have to own your own business. And if you're doing work on your own property, that's owning your own business out there. So
Yeah,
those hours count.
a lot of questions about real estate pro status here.
Yeah.
I think just from a high level here, it's worth finding a CPA that will work with you to actually accomplish what you're looking to accomplish. And much more of this is CPAs sometimes don't want to do the extra work. So they act like they work for the IRS. They're like, okay, this is the rule of law. This is what we're going to follow. This is what we're going to do. And you can say, but what if, just like how you go to your PCP now, your doctor, and ask them for extra blood work. And they're like, oh, no, you don't need that. You don't need that. You don't need that.
You're going to upset the CPAs again, Nick. Careful.
Find a CPA. I've fired CPAs who are lazy and do not want to work with me to actually help me accomplish some of my tax goals. Now, I am not trying to do anything not by the book. They won't even tell me how to do it by the book. So go work and find a CPA that's willing to work with you, tell you what you need to do, help you with your record keeping, help you with your planning, help you with how you spend your time even, and what you need to be working on and what you can do and what you can't do so that you can accomplish your tax goals. That's a piece of advice for you. But the real estate pro status is nothing to play around with. Like the government is very serious about this. If you have a W-2 job and you try saying that you're working 51% of your time on something else, not going to happen. Sorry, not going to happen.
Yep.
So yeah, be really careful about this. Log your time, create an Excel spreadsheet, mark down how much time you're actually spending so that you have record of doing these things.
Yeah, look, Natifa Morris, even with a job, even with a real estate license, I had a W-2 job and the IRS just completely jammed them up, which they will. Yeah, you have to do this stuff by the book.
Rudy has a good question, and I'll ask this of you. He said, I bought an asset in 2021, but I didn't do a cost seg. Can I do a Form 3115 and take some of these tax deductions on my 2025 return if I do a study?
You sure can. Yeah, and you have to file that election on time. So you have to extend your return or get this done before the extension and file on time. So we do cost seg studies all the time, these look back studies for people who place the asset in service at the right time, but never segregated the components of the building out there. And so we can help you with the study and we can prepare the 3115 for you to hand over to your accountant.
And you come in with 4 years of deductions. That's a beautiful thing.
And in 2021, they'll get the 100% bonus. And so if it were like 23 today, you could potentially amend 2021, but because it's been so long, you can only file the 3115. You just have to go forward. So hopefully 2025 was a good year for you and you could use some losses.
Dashia says she works with a realty company and wants to send a lot of our clients to RE Cost Seg. Do we have a partnership set up? Yes, we absolutely do. We'd love to have you refer some business and give you some referral
brokers
fees as well.
Yeah, but brokers, CPAs, anyone, even clients who just want to refer their friends, we love referrals. So recapture.com/partners.
We actually pay $500. We pay $500 for every referral you send us.
So do that.
All right, good. Any last questions you see here, Mitchell? Or you ready to wind it down? Really appreciate everybody's time. Thanks for joining.